Hello and welcome to this very special program. On the eve of Samvat, the new Samvat here, we decided to step out of our studios. It's been 2+ years of COVID, lockdowns and whatnot, and it's finally good to be out. You can see that the enthusiasm is palpable to celebrate and of course enjoy. As we enter the new Samvat here, it is also always a good time to take stock of what has happened and also to look ahead. And to help us do that, we have a very special guest today. Kenneth Andrade is my guest on the program. Kenneth needs little by way of introduction. He has been a star fund manager for 20 years, 20+ years now. He ran money last at an institutional platform, which was IDFC Mutual Fund. And for the last many years, he's been running money at Old Bridge Capital. He manages money for retail investors, high net worth individuals, institutions, both foreign and local, and many others. Assets under management now, the firm, are just under $1 billion. Kenneth, it's a pleasure. Great to have you with us here on the program. It's great to have you with us here.
Thanks, Prashant. It's great to be on the show.
Not in the studio, but outside.
Yeah,
How are things looking, Kenneth? I mean, you know, we are talking at a time when there is great global turmoil, great global uncertainty, but it's always about how much of it is already in the price. To your mind, how much is in the price?
Valuations seem to be almost there. You might give or take another 5% or 10% from there. Remember, it's a matter of time, not a matter of price.
Okay. You mean time correction rather than significant price correction?
Yes. The rhetoric we hear today is recession. We'll have to see what comes out after recession. So we know what's going on in the world economy. The world economy is shutting down for winter. For the simple reason that energy prices are too high, it's getting diverted, there's demand collapse. Demand collapse leads to deflation, okay? And it's quite opposite to the inflationary scenario that we've seen in the past. So
right.
Once you get deflation off, I sense on the other side, interest rates will be more manageable, and the world economy will go back again. So look at it on the other side.
Which is how long? 6 months out?
Post-winter.
Post-winter.
The post-winter is coming
post-winter, prices will be down, the inflation problem would have been tamed. And then you have to look at how policymakers react to that situation. That's what you're saying?
Yes.
So the printing, I mean, starts again, support from policymakers, etc.?
Let's not look at it in such a narrow framework, right? Now let's see what happens on the other side of the world. So Europe is closing down. That's almost 20% of the world economy. When Europe comes out, and the normal noise or normal commentary that I hear is that a lot of European manufacturing is moving out of Europe, right? The problem remains it's an energy problem for Europe. Look, on the other side of winter, they come out with one of the weakest currencies that they've ever had in one of the most industrialized nations that we've ever seen.
Sure.
Okay, and that's going to kickstart a lot of institutions getting back, manufacturing back again, etc., etc.
In Europe? Possible?
Yes. So we're going to come back all over again. So look at what's happening on the other side. And for us in India, I think we just feed into that, into that entire marketplace. So valuations apart, which I think it's already there. I mean, when I look at our portfolio under construct, out of the 20 odd names that we have, at least 5 or 6 of them are almost at price to book of 1. Okay, in my experience and my history that I've managed money, I've never seen 25% of my portfolio having a price to book of 1.
Okay. 25% of the portfolio.
25% of the names that are there are price to book of number 1. There are very few companies that have that exist in the Indian environment that have not gone through that stress test and have come back extremely profitably. So balance sheets have also cleaned up. India corporate is sitting at a historical low in leverage, historical low. So we've got data since 1999. 99 data goes back to say that corporate, the BSE 500 manufacturing or non-banking businesses were at a debt equity of 0.6. We're down to a debt equity of 0.5. Plus, we've got capacity at 75%. Now, this is a killer combination. I mean, you got capacity utilization at 75%, and you got all the capacity to leverage. You got operating leverage and you got financial leverage. So my sense is that you're not going to get stock cheap in India, right? The only thing is that you got to wait it out for some time. You got to wait for the good news, and the good news is not very far away.
Let's get to one area which you really like. I'm talking about commodities, both soft commodities and hard commodities. It's a bit of an anti-consensus kind of view, more so on the hard commodities as compared to soft commodities. Explain why you like that space. What's the basic thesis?
This is the first time, I think, one of the very few times since India's independence, where virtually all crop prices are trading higher than MSPs.
Okay.
Okay. This is the first time that we've seen in history that you've got a large industrialization of agriculture. When I say industrialization, agriculture moving into industrial products, right? You've seen it through the ethanol policy. You will see it getting converted into plastic or single-use plastic over the course of the next year, 2 years or 3 years. So you've got a new use or new demand pattern emerging for agriculture, and that's kept that along with relatively weak or not favorable monsoons has kept supply reasonably tight.
Right.
Okay,
right.
New demand and supply tight, and that's created what we have today.
Right.
I don't ever think that commodity prices will ever be deflationary for a long period of time. One is you got a population growth.
And these are global commodities.
Yeah, global commodities. I'm talking. Once you got commodity, once you got demand getting created from another stream of from another industry completely. Plus you got food consumption going up. Plus you have protein consumption actually moving higher, and all three of them are going to keep prices elevated. Now, when prices get elevated, I mean, let's look at it from a hard commodity standpoint. When say steel does well, the value chain works all the way down to iron ore and coke. So when agricultural commodity prices do well, what happens on the entire value chain? So there are elements of everything that is falling into place. Now we've been holding this since 2016, and the fundamentals of this argument tend to get a little better by every year. So I'm not too worried about it. Policy interventions always come through because at the end of the day, you will necessarily need to control pricing because of inflation. But if there is no supply, there is always going to be a challenge.
This position in the agriculture space you've been holding since 2016.
16 onwards.
And you're happy to continue to hold.
Well, valuations are fair. It's an industry which is consolidated. There is no second or there is no third manufacturer of any of these products out there, and even the converters are getting more consolidated than they have ever been before.
Sure. Hard commodities, you like steel, you like aluminum. Is that the way to metals?
Basically metals, yeah.
Many believe that the steel, that big move that we saw, I mean, we saw the best of it. It's perhaps behind us.
Yes.
You disagree?
Even if it's behind us, at current valuations, the cash flows are going to be very close to almost historical highs.
Okay.
So you strip out 2022 numbers, and you even go back to 2021. You will see a linear growth from 2021. 2022 was excesses that got built up, and cash flows were excesses. But 2023 over 2021, I don't think any investor or entrepreneur or company involved in commodities is going to be disappointed.
One view of yours, which I know you've held for a long time, is not dislike for banks, but you don't find compelling enough reasons to own financials. Mm-hmm. I mean, if you do a poll amongst market participants, I mean, 95% of market participants are bullish financials, right? They are India-facing, they're domestic economy-facing. Economy does well, banks do well. So, what keeps you away?
So let me narrow it down to lending businesses, right? Okay, I got nothing against them. It's not that we don't dislike them, but If you approach the subject like we do, so there's a liability side and there's an asset side. Liability side is banks. Asset side is they lend to a host of other industries, right? We like our position on the other side of the balance sheet. Okay, but let's look at what's happening in financials or banks, in banks, etc. Yes, they've got a very high correlation to GDP growth, but what's happened over the last 3 years, okay, and what's happened in the last 3 years is that the economy is done well. It is not necessary that these banks are all profitable. Okay. So this year you've got a bounce back in profitability, and all of that has come because lower credit costs. My sense is credit costs is going to be part and parcel of what you will see in 2023, 2024, 25, 26. You have to provide for higher.
You're saying problems on the asset quality front are coming back?
It will always be there. It's not going to disappear. It's not going to be. It's always going to be there.
No, but you're saying there's a fresh cycle coming. Is that what you're saying?
I would be very surprised if the quality of the banking balance sheets remain as they are in 2023 year end.
23 year end.
Okay, 23 year end, you'll have a great looking balance sheet, but I'll be surprised if that balance sheet will remain as pristine as it is in 2000.
As solid.
Yeah, and also remember in banks, it's not a spectrum of banks that are doing well. It's narrowed down to the top 2, 3, 4. So now you're down to stock picking in that sector.
Sure.
So look, it was 2015 pharmaceutical picked up, then it was down to stock picking within pharmaceuticals.
Yeah.
Right?
Yeah.
When you had infrastructure peak out in 2008, okay, you had to go down stock picking to make money in that sector. So it was not volume of profitability in that sector moved significantly higher.
Right.
So I'd be careful.
Careful. Fair enough. What else interests you? IT is a large sector, right? Which has been kind of bombed out because of what's happening. Does that interest you? I mean, that qualifies your 52-week low criteria.
Yes. But they're still up almost 80% since for the last 3 years. Right? So they've done extremely well as far as these businesses are concerned. And they've done so because everything's gone in favor of these companies. But what has not gone in favor of these companies is obviously their cost of manpower. I think all of that is getting addressed right now. So valuations are the best that are much better than they've ever looked before. If you go back to that database of IT companies out there, you'll get someone who's available at a 10% cash flow yield. You'll get companies available at a 5% dividend yield. So yes, value in that segment at a 52-week low in a number of those names is emerging, and it's emerging rapidly.
So you got them on the screener, you're watching. Have you bought anything there?
So there are two large contributors to urbanization. One is information technology, and the second is financial services. Okay, and they are predominantly down south and some part of west, and probably a little bit in the north. That's predominantly how urbanization has taken place. And if wage increases remain higher than nominal GDP growth, the consumption pattern in those certain areas could be extremely robust.
I have a feeling you're leading to real estate.
It's the biggest part of your balance sheet.
Right.
Okay.
So play IT, you already are playing this IT-led salary increase boom through the real estate space. Is that what you're saying?
Yes, I think one of the bigger part of everyone's balance sheet has to be real estate. I mean, look at your personal balance sheet.
Sure.
It's either real estate is either on your balance sheet side, or you're paying a lot of rent for it.
Yeah. It's either way big.
It's either way large.
Yeah.
So if you go down the consumption basket, it leads. Yeah. Okay, and then obviously a lot of other industries.
So real estate, indirect play on IT, but IT also getting cheaper and more interesting rapidly, as you said, right?
Yes, there is pockets of value in that business, and it's not going away. It's not going away.
Kenneth, the other space is consumption, and you own a QSR company in your portfolio. You own a liquor company in your portfolio. So you like that space. I mean, urban consumption, really. Just sort of explain that to us.
I think we're just coming back on the fact that the urbanization will pick up a lot of pace at this point in time, and you just have to get companies with and the sense is we just get companies in the right format, with the right expansion plan and with the right cost structures. Okay. So one of the biggest cost structures, I mean, if you look at most of the QSRs, one of the biggest cost structures is royalty payments.
Sure.
Okay. Yes. So if you can actually align a portfolio to take that 5% to 7% cost out, you probably got a business which does have the pricing advantage compared to everyone else. And these businesses are free cash flow. They got their marketplace, their free cash flow. All expansions are through their own cash flows or through their own balance sheet, and no dependence on any external resource. So we're in infancy in that industry, and globally that industry has become significantly large. So there will be an expansion of that one particular place, and it could get reasonably large. A similar thing with the alcohol beverages companies, very consolidated place, enormous barriers to entry, both in terms of distribution and making the product price available. So all of these companies come in with their individual structures, wherein it's extremely difficult for competition to come in and
Disrupt
that business.
Take away market share.
So if you can get all of these at the right price points, you go back about 3 years and all of these were there. You go back to IPO stages, and when these businesses corrected, they were all there. I think you just have to wait your time on all of these companies, accumulate large amounts, and just wait for them to monetize it all.
You own a urban waste management company as well. Is that a? I mean, there are very few plays on that theme. If you want an exposure, is that a? I mean, you want to talk about that briefly?
So for me, if I have to bracket that company into a particular economy within the country, it will definitely go in line with the consumer economy in the country. Why? Okay, why does an urban infrastructure company get categorized as a consumption business? Because simply put, the higher the per capita of the city gets, okay, the more the municipality will spend, or more the authorities will spend on social infrastructure.
Right. Hopefully.
No, that is always a underlying demand that will always be there. It is water, waste, and sanitation. This is definitely there, and you've seen this happen. You've seen this happen in all underdeveloped economies to a developed economy, right? And these are the three places that are there. And I think if you look at the Indian context, large concentrated pools of individuals into smaller island cities or cities, the need for infrastructure like that to build out is the demand is far ahead of.
But this also means a lot of interaction with governments, municipalities for that matter, local government bodies. I mean, is that a risk at all, or that's a risk you're willing to take given the opportunity size?
So, how much of that is factored into the valuations is what you need to check. And if it's available at a 10% cash flow yield, what's the problem?
Got it.
Okay. So what we do from an investment process is we actually look for the reasons why others do not want to invest in, the reasons why these companies are available at that pricing, and once they establish that the inverted comma growth cycle, we monetize that holding.
This is not about what you invest. One more question, like banks, what you don't invest or don't have too much exposure is local manufacturing. Why doesn't that find larger share in your portfolio, Kenneth?
So local manufacturing, every business that we have has got domicile manufacturing.
Right.
In India.
I mean the capex theme, right? I mean
okay. So let's look at where the capex is, right? The capex is happening in steel, it's happening in chemicals, it's happening a little bit in infrastructure, which is purely domestic. It's happening in pharmaceuticals. IT is putting in an expansion plan. So every time that you talk about capex opportunity happening is in industries which are outwardly looking. right? We are surplus steel, we are surplus chemicals, we are surplus, or look at the capacity in chemicals, it's all coming outbound. You look at the capacity coming up in IT, it's all outbound. You look at it from pharmaceuticals, it's all outbound. In two-wheelers, it's all outbound.
Sure. Sure.
Okay, so from a domestic context, okay, I think it's probably a decade where India goes out with its companies or with its entrepreneurs and establishes a fairly large footprint and market share globally.
Got it.
Right, and the opportunities exist. Today, the opportunity exists because the world's largest manufacturer is stepping out of or trade reallocations are taking place.
Sure.
So if all the Indian companies want to sell all the cotton yarn in India, there is no market.
Right.
If the amount of fabric that we produce and want to sell it all into the Indian market, it doesn't exist.
Right.
Okay. So that's where the bias is. So if capex is there, capex is coming because these front-ended businesses have to create their markets abroad, and it has to be profitable for them to reinvest in their economy, into that workplace. So I think that's what's leading our thought process and on that extent our portfolio construction.
Kenneth, thank you so much for being with us here on the program, and let me wish you and your family, your team, a very happy Diwali from all of us here.
Likewise, Prashant, it was lovely being here. Wish you, your team, your family and all the viewers a very, very happy Diwali.